There are 7 things killing your wealth, yet nobody's talking about it. And no, I'm not talking about your Starbucks or the extra guac you get at Chipotle. Let me just jump in with the biggest wealth killer there is, which is the place that you live. And I'm gonna come at this from a kind of a wide-angled perspective because I'm a real estate salesperson. I invest in real estate. I'm a licensed attorney. Now, when I was a real estate salesperson, one of the pitches that you get to help entice and close sales is you gotta tell the buyers that this home that you're buying is the biggest and best investment that you're going to make. Now, when you pitch this home that you live in as an investment, it's easier to get somebody to buy bigger because remember, realtors are on commission, right? And so if I can tell you that this home that you're gonna live in is gonna help build generational wealth, you're gonna help pass it on to your kids, and you're investing for the future. I mean, you don't wanna just keep moving out of homes, so buy something a little bit bigger, a little bit nicer, which means more dollars. Now, what you wanna understand about this is the home that you live in is not actually making you any money. And every time I say this, this makes a lot of people angry because people say, well, Jaspreet, I bought my home for $435,000. It's worth $585,000 today. What do you mean it's not making me any money? Well, the question is how much money actually went into your pocket? Because the only way you can get that money is if you A, refinance that money out, which means now you got to pay interest on that and then pay it back. And then number 2 is you can sell your home, but then you no longer have a home. See, the problem with your home is it is a money pit until you come to sell it. And then when it comes time for you to sell it, you have to hope that you can sell it for a profit because there's a chance that you won't be able to sell it for a profit. How do I know that? Because I've purchased a lot of real estate investment properties out of foreclosures because the homeowners couldn't sell them for how much they purchased them for. So the home that you live in is a money pit because you got to pay for the mortgage costs or the rent costs, you got to pay for the upkeep, you got to pay for the maintenance, you got to pay for the property taxes, you got to pay for the insurance, and everything else related to your home. And so when you get into this whole idea of I'm going to build wealth by paying off of my home, what you got to remember is you're still paying to live in that home. Even if you pay off the home, when you still have to pay property taxes and insurance and the upkeep and the maintenance and the upgrades, all these costs are still yours. If you look at your home more like a liability, where now this home is an expense, your other investments, your stock market investments, your business, your real estate investments, your rental properties, these are your assets. You flip the script because now what you can do is instead of spending so much money here on the home that you live in, you can spend less money here and put more money into your real estate rental properties, into buying stocks, into your own business, into your savings, into paying down debt because you're not investing so much money into this place that you live. This place that you live is an expense. And when you treat it like an expense, you're going to live a little bit smaller, which seems a little bit uncomfortable. But it's the biggest expense for so many Americans. For most Americans, their number one largest expense is their home. So if we think about now, how do we actually help people build wealth? Most people are focusing on the pennies. They're focusing on the Starbucks. They're focusing on the extra guac. They're focusing on the shoes that you buy. When what we could do is flip the script and work from the top down. What are your largest expenses? They don't have to be so large. Because guess what? If you can downsize your home, that could be an extra $500 a month. An extra $1,000 a month, an extra $2,500 a month, depending on where you live, which you could transfer into your investments that can actually help you build wealth. This brings me to number 2, your car. If you don't like me after number 1, you're definitely not going to like me after this. And the reason why I talk about your car is because we're going down the list, top to bottom. Your home is the biggest expense for most Americans. The second biggest expense for most Americans is your car. And your car is also a liability. The reason why it's a liability is because for 99.9% of people, as soon as you buy a car, it's going to drop in value. Every time you drive that car, it's going to drop in value. For every year you own that car, it's going to drop in value. And so now, when your car loses value, what do most people do? They go out to finance a car that they can't afford, which means you're paying interest on something that's losing value that has a limited time span. And this is where I want you to rethink this. Instead of buying such an expensive car, what if you use that $8,000 down payment that you used to buy the BMW to just buy an $8,000 car? Now, you get to still have a car which takes you from point A to point B, but you don't have the $800 monthly payment. It's a very different game. And the reason why this is so difficult is because you got a nice job. You went to college. You finally got this nice career. Maybe you got a couple of promotions. And now you're going to drive around in a beat up Toyota Corolla? Doesn't make much sense. But see, the key is, what do you want? Do you want to build wealth or do you want to look like you're rich? Most people want to look like they're rich more than they want to actually be rich. But what's happening in America today, I'll just give you some statistics. About half of America today has zero investments. And what I mean by that is zero stock market investments, zero real estate investments, zero business investments, zero 401k investments, zero IRA investments, nothing. Half of America has no investments at all. Yet, at the same time, 1 out of 5 Americans that are going to buy a car today have a car payment, just the car payment, of more than $1,000 a month. If you're paying $1,000 a month for your car payment, but you're not putting $1,000 a month into your investments, your priorities are in the wrong place. But it doesn't even have to be $1,000 a month. If you're paying $500 a month to finance a car, but you're not putting the same amount of money into your investments, your priorities are in the wrong place. And this is where you got to understand, do you want to make BMW richer or do you want to make yourself richer? And once you start answering that question, then you got to change what you do. And the reason why it's so hard to change what you do is because it's uncomfortable. It's uncomfortable to let go of that car when you're so accustomed to the heated seats, when you're so accustomed to that nice dashboard that has the Apple CarPlay in it. But the key here is the goal is for you to be able to have all these nice things, but be able to afford them without worrying about the price. See, I want to make sure this is clear. My goal is not for you to live in a shack and drive a beat up car for the rest of your life. I want you to make the right decisions with your money today, make the big decisions, because these things can save you a lot of money. We're not talking about the $5 at Starbucks or the $2.85 for the extra guac. They probably raised the price of extra guac. Whatever the cost is for extra guac, we're not talking about the $5 decisions. We're talking about the $500 decisions, the $5,000 decisions, the $50,000 decisions, the big decisions that can make a much more scalable impact on your wealth. Because guess what? If you're not spending $500 or $1,000 on this car, that's money that you get to keep, that you can invest. And I'm not even talking about the more expensive insurance, because guess what? Insuring the BMW is more expensive. The premium gas on your BMW, your Mercedes, your Audi is a lot more expensive. And the maintenance, you don't even need me to say, you already know. The maintenance on those German cars are expensive. Which, guess what? If you can afford it, great. But if you're not putting the same amount of money in your assets, you can't. The third wealth killer, you're gonna get a kick out of this one, is being cheap. And this one, I learned this one the hard way because I was bred to be cheap. I grew up in a traditional Indian save-heavy household where you don't spend money on anything. And so when I grew up in that kind of environment where I'm gonna penny pinch everything, where I'm gonna reuse my brown paper bags, or I'm gonna reuse my Ziploc bags, or I'm gonna reuse everything possible, well, it was very easy for me to be cheap, which is fine in some instances. In certain parts of your life, it is fine, okay? But when you translate that to business, that being cheap can be very expensive. I'll give you a quick example of this. When I started getting into business and investing in real estate, I needed an accountant to help take care of my taxes and my bookkeeping. So what did I do? I found a cheap accountant. A cheap accountant is somebody that's not going to charge me a lot of money every single month, which means I get to keep more money, right? Well, yeah, maybe for a little while, until you realize that that cheap accountant is actually costing you a lot of money. What happened was this cheap accountant was doing my taxes late all the time. But I didn't really think much of it because my taxes were still getting filed and maybe I paid a little penalties here and there, but at least I save a lot of money on my accounting fees. But then what really pushed me over the edge, I mean, I always never really liked the accountant because it was kind of always this like, I knew that things were not the best, but who cares because I'm saving money. I got a call one January. I'm in the office. And my accountant calls me and says, "Hey, Jaspreet, how you doing?" If your accountant's calling you, it's generally not good news. I said, "Hey, how's it going?" And he said, "Hey, Jaspreet, I need you to do me a little favor. Could you wire the IRS $100,000 by the end of the day today?" I said, "Excuse me?" He said, "Yeah, we had some miscalculations and we need you to send an additional $100,000 by the end of the day." And then he says, "Also, could you also send $18,000 to the state of Michigan by the end of the day today?" I said, "Excuse me?" "Yeah, sorry, we also didn't do your state taxes properly. So if you could just do that, that would be great." And I'm kind of silent and in shock. And he then responds by saying, "Oh, by the way, you're also going to get a late fine and penalty on this as well because you didn't pay the time." And at this point now, I'm kind of getting a little frustrated and upset. And I said, "Whose fault is this?" And my accountant, true story, says, "It's nobody's fault. It was just something that got overlooked." Now, I don't know about you, but if I have to pay $100,000 to fix somebody's mistake, somebody is at fault, especially if I'm paying penalties and fines on top of that. There's somebody's mistake that led to this fault. And so I paid the money, and then I proceeded to fire the accountant. And then I got a new accountant that I pay many multiples of what I was paying the old accountant. But now when I get calls from this accountant, which are rare, they're very different. It's, hey Jaspreet, I got some good news. I found a way to save $60,000 in taxes on your tax bill because we were able to do this new deduction that we just found. It's a very different scenario. I pay a whole lot more money for it. I get a very different experience. I get a very different service. It costs more money, but it keeps more money in my pocket. It was the same thing when I started investing in real estate. I hired the cheapest property managers that I could find, and guess what? Those property managers were cheap. The problem is when it comes to business, when you hire the cheap, you get cheap services. And in business, what you're trying to do is you're trying to grow incomes. And when you hire cheap services, all your time, your effort, your energy is going in to manage the cheap services, so you don't have any time or energy or resources to actually focus on growth. And when I hired the cheap property managers, guess what? They didn't do their job. They're not working to increase the rents. They're not working to manage the properties. They're not working to manage the expenses. So now you have all these other expenses going out. Sure, my property management fee is low, but they're not doing any work. And they don't have any resources to actually take care of the properties. And now everything is getting messed up. And then when I realized this, I have to fire the property manager, and I realized that all the work, all the construction, all the maintenance that was done on the properties was done cheaply because it was managed by a cheap property manager. And now I have to pay to fix all the cheap mistakes. And it's even worse than when I had a cheap contractor, which I also had. Same thing. I had a cheap contractor. I paid him cheap dollars to do the work, which was fine in the beginning because it kept more money in my pocket. But then I realized that when you have a cheap contractor doing cheap work, the cheap work falls apart. And when the cheap work falls apart, now you got to pay a good contractor who costs more money to not just fix it, but they got to undo the work. So now it ends up costing multiples how much it would have cost if we would have just paid a good contractor, a good property manager, or a good accountant in the first place. The fourth wealth killer that I want you to think about is impulse investing. And I'll just go right into an example here. When the 2020 pandemic happened, we saw the stock market crash at some of the fastest rates in the history of time. Now, let's take a step back and talk about this. When the stock market goes down, what should you do? A, should you buy? B, should you sell? Now, it might seem obvious. If the stock market is going down, it's a great opportunity to buy. But what do you think actually happened? Is it A, were people buying, or B, were people selling? Well, let me just show you. When we got news of the stock market falling, we also got news of people selling out of their retirement portfolios because people got scared. This is emotional investing, and we have seen this in every single market downturn. We have seen this in every single recession. Now, there's two reasons why this could happen. Reason number one is people that are trading or investing in margin, meaning with debt. And then you're forced to sell off your investments because the lender, your brokerage says you have to sell because you're underwater on your investments. You don't have an option here. But then you have option B, which is the people that are emotionally investing. You're investing for the next 40 years, the next 30 years, the next 20 years. But then you see what happens over the course of 1 week, and now you get scared, and now you sell. And this, unfortunately, is the emotional investing that ends up killing so many investors. But it doesn't just happen on the way down, you also see it on the way up. Because when you see investments going up, what happens? Well, you hear people talking about it on the news, you hear people talking about on Reddit, you hear people talking about it on your Discord channel, you hear people talking about it in your group chats. Now you don't want to miss out. You don't want to miss out on the next hot stock. So then you start buying. And immediately, as soon as you start buying, what happens? That stock always starts to go down as soon as you start buying. Why is it that always you start chasing the stock, it starts to go down? Well, this is what impulse investing is. This is emotional investing. And that's why I always say you don't want to be investing based off of emotions. You want to be investing based off of financials and trends. See, most people are focused on the news. I want you to focus on the trends. And this is really a wealth killer because it forces you to buy at the wrong time, and then entices people to sell at the wrong time. So we all know buy low, sell high, right? That's how you build wealth. But what ends up happening to most people is end up buying high and selling low, and then you end up making somebody else really rich because you were so focused on your impulses and your emotions as opposed to the financials and the long terms and the trends. And instead of capturing opportunities, you're giving opportunities to somebody else. And that's where you got to be able to separate the emotion from the trend. Now, one of the easy ways to do this is just to understand the news from an unbiased source. That's why I created Market Briefs as a free and easy to read newsletter that breaks down what's happening in the financial news. You can read it in less than 5 minutes every morning, and it's completely free. If you have not joined Market Briefs yet, I got the link for you down in the description below. The fifth biggest wealth killer are your short short-term loans where you're getting close to the next paycheck, but you got to pay for your groceries, you got to pay for your rent, you got to pay for whatever expense that comes up. And so what do? You go get a short-term loan. You use your credit card to finance these things. And let me just show you how dangerous this is, because right now the average credit card debt in America is right around $6,500. That's how much the average household with credit card debt is carrying. The average APR, the average interest rate on this credit card debt is right around 27% a year. Now, let's assume that you're like the average person and all you do is you say, oh, that's not that big deal. I'm just gonna make the minimum monthly payments. You know what that means? That means I'm gonna pay $150 a month. And you might say, you know what, it's not that big deal because it's not that much money. I can afford to make it, but it helps me get by month to month because now I can buy those groceries, I can go on the little vacation, buy myself a little nice thing here and there, and I can pay for my car expenses. So you pay $150 a month, you don't think that much of it, but the amount of money you're gonna pay in interest on this $6,500, it's gonna take you forever to pay it off. And the reason why is because you're gonna pay, with these numbers right here, more than $18,000 in interest to pay this off. That means it's gonna cost you more than $24,000 to pay off your $6,500, more than 18 grand going into your credit card company's pockets. And this is at a 27% interest rate. When you go and get a payday loan or those short-term loans to make ends meet for the 2 weeks or for the month, you're not paying 27%. You're paying 50%. You're paying 100%. Now sure, you're paying it back with these small little fees, which might not seem like huge percentages, but when you annualize the amount of interest that you're paying on the small little flat fees, this is how much you're paying. When you pay a 27% interest rate on $6,500 with the minimum payments, this is how much you're paying in interest. It's even worse when you're getting those payday loans. And so this is where the better thing to do now is not to get that little extra cash boost to get by paycheck to paycheck. It's now to suck it up a little bit and see where you can cut back, see where you can earn some more money to make it without making somebody else rich. Because unfortunately, the credit card company, the payday loan company is soaking it up. They are milking you and they are getting rich off of your bad financial habits. But it doesn't have to be that way. And it starts with you making the decision to say, okay, you know what? I'm gonna stop making you rich. I'm gonna stop making you rich. I'm gonna stop making you rich so I can make myself rich. And yeah, it's hard because that means you gotta sacrifice some nice things, right? I get it. It is difficult, especially when you're used to a certain lifestyle. But if you can stop giving this money to them, you can start keeping this money for yourself. And once you start keeping it for yourself, you can start using it to make you even more money. The sixth wealth killer is impulse purchases. Back in the day, we'll call this 10 years ago, an impulse purchase was you go to Macy's. You're walking down because you need to get a sweater, but as you're going to the sweater section, you see a nice pair of pants. You see a nice jacket. You see this nice watch and you say, ooh, that looks nice. I'm gonna get this. Maybe I don't need it, but I'm gonna get it $200 extra down the drain. And those impulse purchases used to only happen when you go to the mall or when you go to the grocery store and you buy your groceries. But now it's become so much easier to make these impulse purchases because when you go and shop on Amazon, because I shop primarily on Amazon, they are very good at knowing what you want. And they're very good at suggesting things that you might want. You don't even know that you need it. And now when you're on this TikTok shop, you got people telling you what type of salt you need to buy, what type of soap dispenser you need, what type of pants you need to wear. I mean, there's just everything on the TikTok shop that's making it so easy to buy things. And so it's become so much easier to do these impulse purchases. But I'm gonna give you a little trick that you can do that can help you save so much money in these impulse purchases. Because if you give yourself what I like to call the 24-hour rule, what you're doing now is you might find something that you like. You find a new watch that you want to buy. You put it aside, but you don't buy it that same day. You give yourself a rule that you're not going to say no, you're not going to say yes, you're just going to say maybe. And you give yourself 24 hours. You have to actually wait the 24 hours, which is where you sleep on it. And then you wake up the next morning in a calmer mind and you say, do I still need that watch? Do I still want that watch? And if the answer is yes, and you can afford it, you're giving yourself the permission to buy it. But if you say no, now you don't buy it because these impulse purchases can add up very quickly. Like the easiest way to have an additional $5,000 a year is just to not spend an additional $14 a day. If you can keep that $14 a day, you're gonna have more than $5 grand at the end of the year just because you did an impulse purchase a lot of things that you didn't even need in the first place. And the grand finale, the seventh wealth killer that I want you to understand is to Never blindly listen to a random guy on YouTube. Now look, I talk about me being a random guy on YouTube all the time because I'm not here to give you financial advice or talk about what I do, but I want you to take this from a broader perspective and understand that there's a lot of people on the internet. There's a lot of people with opinions on the internet. There's a lot of people with different thoughts on the internet. And every single person has a different opinion, they have a different thought, they have a different risk tolerance, and they have a different goal than you. One of the reasons why I don't give stock picks is because what's right for me is probably not right for you. My goal is probably not your goal. My risk tolerance is probably not your risk tolerance. And so now when you go on the internet, everybody's telling you in the financial space, buy this, sell this, do this, don't do this. And I try to make it a priority and important thing for me that I never try to tell people, go out and invest in real estate, or you have to invest in stocks, or you have to invest in index funds, because for some of you, you might only invest in real estate and build your wealth through real estate without touching the stock market. Some of you are going to build wealth through the stock market without ever touching real estate. Some of you are only going to want to invest in index funds. Some of you are only going to invest in mutual funds. Some of you are going to do everything. And some of you are going to go out and build a business and never invest your money into any other asset. So there's a lot of ways to go about doing this. And you got to be careful now because everybody on the internet has an opinion and they talk about their own opinions. But you got to be careful not to let somebody else's opinion become your fact. And this is where being able to dissect opinion and fact is so important, but also then on top of that, because I think there's a lot of good education on the internet. In addition to that, you also have some not so good education of people trying to sell you a system or this idea or this dream. You pay me $997 and I'm going to show you how I can get rich in 6 months with my 6-step system. And I'm not saying online education is bad. I think there's a lot of really good online education. I have spent tons of dollars on online education, but there is also that small sect of people that are just trying to sell you a dream, which is not going to make you any money, but it's going to make somebody else rich. And this is where I want you to take things with a grain of salt, but be able to analyze and apply things to your own life. In business, one of the things that we like to talk about in our own company, Briefs Media, is there's a lot of different opinions on how to do things. Like if we're trying to improve our search engine optimization, people will say, these are the 5 steps to get your website onto the first page of Google. You do these 3 things, these 5 things, and you're going to be able to get on the first page of Google. But if everybody is now learning how to do this, everybody's going to be doing this, and now it's the mass market. And this is where one of the things that we talk about is, okay, learn from other people. But how do we apply it to ourselves? And the way you apply it is by innovating, not copying, but innovating. And that's what you should be kind of doing is you learn from people and information, whether it's on the internet, whether it's on podcasts, whether it's on YouTube, whether it's through books, whether it's through classes, whether it's through coaching, and then you learn to apply things to your life. You can't just blindly carbon copy somebody else and expect it to give you the same results. It does not work like that. You got to be able to learn and then you got to be able to apply because that's where the real wealth is built. Now, before you go, I have a quick request. If you got value out of this video, do 2 things. Number 1, hit that thumbs up button below and make sure to subscribe to this YouTube channel. That way we can get notified when I release new videos. Well, I have this money. It took a lot of work to put aside this $10,000. I don't want to lose it. So what can I do now to invest this money with the least risk possible and also the fastest way possible? See, it's kind of a difficult answer to answer here, but the way that you can do this is by understanding, number 1, how do most people lose money in the markets, and then number 2, not do that thing.